Hello everyone, I hope you guys can hear me. Please send me a chat there to see if you are there, if you can hear me. After so many live streams, Hussein finally convinced me to use a camera so I could be seen during the live streams. So today is the first time I'm using a live stream, actually a camera for a live stream. So please let me know if you can hear me, if everything's okay there, or let's see. Hello, Marcos. So can you hear me, Marcos? Sounds is clear. Fantastic, thank you. Well, today we are meeting probably about 2 or 3 weeks after we finished our life intensive. If you recall, we had probably 5 or 6 intensive sessions on the wave principle, and thereafter I received dozens of questions, really dozens of questions. And I thought, well, what I'm going to do is to make a video for each one of those questions. And then I decided that instead of making 300 videos for those questions, why didn't we just meet here and discuss those questions? Because sometimes it's a lot easier to interact and discuss them live. So if you have questions, please start sending them to me, and I'll be more than happy to clarify whatever doubts you have regarding the wave principle. Marco says, I have some questions. Yes, please start writing them, and I'll be very happy to clarify them for you. So I'm just waiting here, giving you time to write all your questions and have them ready. So after I take the first one, we continue directly with the next one. And what's more common to find, impulses or diagonals? That's an interesting question. What's more common to find, impulses or diagonals? Here's the thing to understand. I have my charts here so I can draw for you. But here's the thing to understand. The essence of this question is very, very, very interesting, because you have to think in percentage-wise what's more common. But the reality is that diagonals are part of impulses. So when we are discussing what is common, what is more common, impulses or diagonals, we have to put this into a better context, because impulses are of two kinds. We have the leading, not impulses, diagonals are of two kinds. We have the leading diagonals that look like that, right? You probably remember this. And then that would be for wave 1, and then wave 3, 4, and 5. So typically we connect these 2, 1, 3, and 2, and 4, and then we have our leading diagonal, which is going to be labeled as a 1, 2, 3, 4, and 5. So if we think of this question, really critically, we can say, well, we cannot say that the diagonal is more common than the impulse, because it's part of it. So, but we could think, what's more common? A leading diagonal for wave 1 or an impulse for wave 1? And so that would make a lot more sense in terms of context. And in terms of context, theoretically, and I must really put weight on that word, theoretically, leading diagonals are rare. That's what the books say. But practically, leading diagonals are very common, at least in my experience. So I would think that if we have to compare leading diagonals with impulses for wave 1, I would probably put the leading diagonals in probably something like 40% of the times, whereas the impulses for wave 1 would be the other 60%. Now, in terms of ending diagonals, which are also very common, they would be part of an impulse 1, 2, 3, 4, and then the ending diagonal would be would take the place of wave 5. So leading diagonal would look something like this, right? In which we connect wave 1 and 3 of it, and then we connect wave 2 and 4, and then we have that wedge shape. We can cut this so you can see it better, and the same here, so you can see that shape much clearer. So this would be an ending diagonal. And for an ending diagonal, well, it occupies the place of a fifth wave. So the question here, if we reframe that question, what is more common? An impulse or a diagonal? So now we know, well, if we have a diagonal, we've got to have an impulse, right? So it's kind of part of it. But if we reframe it and say, well, what's more common? An ending diagonal or an impulse for wave 5? And in that case, I would say ending diagonals are extremely common. They appear very often. You can pretty much count on their appearance, probably a good 70% of the time. And please don't hold me to that number, because it's really hard to come up with stats that way. But I would say they are extremely common. They are expectable. I mean, if you are waiting for a wave 5 and wave 3 was very strong, then that means that a diagonal is very likely to occur. So I wouldn't even say 50-50. That's why I would say the ending diagonals will have a much higher percentage of appearances than the leading diagonals. But I would disagree with the fact that leading diagonals are rare, because they are not. They are seen very often. And I think one of the reasons is perhaps because if the impulses for the wave 1 were more common, it really would make it a lot easier for us to identify the change of trend. So that's not the case, really. The change in trends are typically tricky. And one of the reasons why they are tricky is because they appear, let me make a drawing. Let's say that we have a downtrend. Okay, we have something like that. And so now the change of trend begins with 3 waves. Well, typically when we see 3 waves, we would think, well, 3 waves are corrective. Therefore, this is not a change in trend. This is just some sort of correction from an internal wave of something much larger. But then prices come down in 3 again, and they continue moving in 3 again up, and then move in 3 again down, and then again in 3 up. And so this makes it very confusing, because when you see this picture, you would think, well, that's very corrective. It has a corrective look. It has a corrective nature. What's a corrective nature? Well, it's slow, it's sloppy, it's choppy, it's overlappy, and therefore you would think, well, it's corrective. So you would predict that the next move would be to the downside, and it happens that that's not the case. In reality, it's at wave 1, and then when it retraces in 3, and then goes up as a wave 3, and that is a change in trend, and therefore it's very tricky to identify the trend very easily. And the reason is precisely because leading diagonals. And so I completely disagree with the textbooks that say that leading diagonals are rare. Okay, hope I answered your question. Sorry for the going so long with that. Let's see, we have many more things here. What's more common? Okay. Hello, Miral. I sent you an email today. Yeah, good question. Great. What if I go... Okay, let's see. What if I go to the extreme low of a chart and I still can't spot the 5 waves up? Is it a must to start counting from wave 1? Okay, this question is also tricky because it has 2 parts. So the first part is that if I go to the extreme low of a chart and I still cannot spot 5 waves up, well, that could be because the 5 waves up are not complete yet, right? So we couldn't really say why the 5 waves up are not there. Let's say that we have a chart and this is the low, and you start spotting something like this, and then you say, well, I can only spot 3 waves, so what do I do there? Well, in reality, it's probably because the 4th and the 5th are not complete. And one of the tools that we use to avoid this is that we don't go long or short in a change of trend unless we see the major, let's say, the major sign that the trend has changed. And the major sign that the trend has changed is not an impulse, it's a complete 8-wave cycle. So unless we have an 8-wave cycle, we don't want to risk the long side, right? Because, well, it is extremely risky. As I said before, this could be part of a correction. It could be that we have an A, B, and now this is a C of a correction, and now this just start coming down. So we don't want to trade the extremes without an 8-wave cycle. Now let's say that you are in an uptrend. You have this 1, 2, 3, 4, and 5, and let's say that this is a daily chart, and so you want to now trade the downside because you see 5 legs there on the daily, and you think that, well, there is enough opportunity and time for prices to come all the way down to this level. Therefore, you don't want to miss that opportunity. So should you wait until there are 5 waves down and 3 waves up? Well, by the time that happens on this time frame, it could be absolutely too late. So you don't want to do that. So what you do is that, yes, this is a daily chart. You spot the 5 legs in the daily chart, but now you go to maybe an hourly chart, or maybe even less, and then you try to spot, in an hourly chart, you try to spot those 8-wave cycle. And then when you spot that 8-wave cycle in an hourly chart coming from that top, now you can justify going short with a lot higher confidence than if you would come short here just because you counted 5 waves. Now, again, there are other possibilities. There are multiple possibilities here. For instance, let's say that in these 5 waves, let's draw them again. Let's say 1, 2, 3, 4, and then the 5th leg is extremely clear. It has 5 legs, and even the 5th leg shows 5 legs. Well, you could indeed risk going short at the top, but you would still have a strategic problem there. What's the strategic problem that you have there is, well, I go short here, but where do I know I'm wrong? What happens if this continues moving a little bit higher? Where do I get out? You don't know. And the reason why is because you don't have a place to place your stop when you go short at the very top. Even if you had the 5th leg clearly defined as 1, 2, 3, 4, and even the 5th 1, 2, 3, 4, 5. Even if that were the case, sure, you could pretty much bet that the next meaningful move will be to the downside. And depending upon your level of, I would say, risk need and or tolerance, and the need for adventure and probably the need for adrenaline and whatever, you could go short there and risk it, even if it goes a little bit higher and then start coming down. I can give you an example of that happening right now. I was looking at it a few minutes before. Let's see. We have here let's put it in a smaller time frame. Okay, so if we go to this time frame, we could label this as a 1, 2, 3, 4, and 5, right? So notice how clean those 5 legs are. And this 4 is pretty much a triangle. You can easily see it there, right? Let's take this away so you can see it better. That's pretty much a triangle where you have an A, B, C, D, and E. Wonderful. And then from there you have a 1, 2, 3, 4, and 5. So you have those 5 legs there. So the problem is, should we go short right there? Well, it is possible to go short right there, but this is gold. So if you go short right there and market, this is making only 1, 2, 3, 4, and still 5, you're going to suffer. Even though the upside is limited, you're going to suffer. So you would need to go to a smaller time frame and try to spot those 5 waves. 1, 2, 3, again another triangle, 4 and 5. So it's possible that you have in these 5 legs, it is possible. But ideally you want to even, this is only a 15-minute chart, but here you could probably go and wait for, let's say, a 5-wave move, 1, 2, 3, let's say 4, 5, and then A, B, C. And when you enter at this level, then you would have a much clearer entry to the downside, because even though you had your 5 legs up, well, you will have a level of confidence here that is strengthened by your stop, because your stop now is right here. If we enter right there where we counted the 5 legs, well, where is our stop? Well, we don't know. We are going to have to play by ear. And when you play by ear, when your trade is not completely planned, then your psychology will play real tricks on you. Now, the other part of your question was, is it a must? Let me see. Is it a must that I start counting from wave 1? So something like, is it a must to start counting from wave 1? Well, not really, because when you start counting, you may start counting from whatever pattern you recognize. For instance, let's say that we're counting this chart itself. Let's say that we're counting this chart, and what we see here is, well, it's very clear, right? It's a triangle. Let me make it a little bit bigger so you can see. A, B, C, D, E, right? Very clean triangle, because you can see this high here couldn't go beyond this high, this low here couldn't go beyond this low, then this high couldn't go beyond this high, and this low couldn't go beyond this low. Well, the prices are contracting, meaning that, well, it's producing a triangle. So if you have a triangle, actually I have a perfect example for you here. It's an example on stock that I was reviewing with some of my real favorite students, and we were reviewing this on a monthly chart, and this is going to help you understand, is it the most used accounting from wave 1? And here I will demonstrate that it is not. Okay, so let's go through this chart. First thing I'm going to show you here is that, well, the prices go from very low here at $7, and it's going all the way there to 110. So the price has multiplied multiple times, and so we don't want to use an arithmetic chart. We have to change the chart to a logarithmic chart, and then we're going to have a completely different view of it. Okay, so now we have a logarithmic chart. And then again, in this chart, we can see the same effect that we were looking at the gold chart, which is prices are contracting. So if you put some trend lines there, you would see, if you go from here to here, you would see, oh, prices contracted. And if you go from here to here, you would see prices contracting, right? So clearly, you can see there is a triangle there, a triangle that you could label, let's label it as A, B, C, D, and E. Okay, so think about it. You went from the, oops, I don't even know how to get rid of this. How? No idea. Let's keep it there. Let's see if we can move it. All right, so here's the thing. Your question, for instance, what if I go to the low of the chart and I still cannot count 5 waves? Well, my very first and obvious answer was, maybe the 5 waves are not complete, right? That's an obvious answer. But let's apply that to this chart. And so we go to the very bottom, and here it is, and then we count 1, 2, and we still cannot count 5 waves, right? Because, well, this didn't go above here, so it doesn't qualify as a third wave in no way, shape, or form. Therefore, we couldn't count 5 waves up counting from here. But going back now to the other question, is it the most that we have to start from wave 1? Well, no, because in this case, we don't even have a wave 1. What we have here is clearly a pattern that we recognize. So the very first thing that you should ask yourself when you are in front of a chart is, do I see a pattern that I recognize? And so when I started looking at this chart, I show you a pattern that I recognize. A high here that was not exceeded by the next high, a low here that was not exceeded by the next low, and another low that could not exceed the previous one. Therefore, what we have there is a triangle. Now, this is very revealing, because as you learn in the intensive, you know that triangles by themselves cannot occur in a wave 2. Therefore, even though we don't have the first leg of this stock, we cannot label this as a wave 2 because it's a triangle by itself. Therefore, we know that the rules say triangles never appear by themselves on a second position of a structure. Okay, well, how about of an impulse specifically? Now, how about the fourth wave? Well, triangles tend to appear on the fourth wave when they are by themselves, I'm talking, right? So this one is by itself. So, is it possible that this is a wave 2 and this is a wave 3? Well, the answer is not, because this is a triangle by itself, so it can only be a wave 4, right? It could be a wave B as well, but let's say the outcome would be the same. If this is a triangle by itself, it means that it precedes the last move of structure. Meaning that if this is a fourth, this is a fifth. Meaning that if this is a B, this is a C. And that means that, well, if you start counting from the bottom here, you don't always start counting 1, 2, 3, 4, 5. You can start counting ABCs as well. For instance, in this case, we started counting the B, assuming that this is an, let's say, let's draw it this way. Let's say that we have an A coming up here, triangle B and C. That would take the shape of a zigzag. It would be like A, then triangle B and C, a zigzag. So notice that now not only you didn't start from the bottom, you didn't start from wave 1 either. So at this point, well, you started from the middle of the chart, which was the structure that you recognized. So really, to be very, very, let's say, very short in the answer would be, must I start from wave 1? And the answer is no. You don't even have to think you must start from wave 1, because that is one of the big downfalls of novices. Every time they are going to count something, they start counting wave 1. But what if there is no wave 1, as in this case? There is no wave 1 here. There is a potential A or 3, because we have here a wave 4 or B. Therefore, we don't have a wave 1. So where do we start? We start from a pattern that we recognize. And instead of thinking 1, 2, that's what everybody thinks when he looks at the chart, 1, 2, you have to start thinking, is there a pattern there that I recognize? And if there is, just look at that one, label that one, and then consider. If that is a correction, well, maybe then it's a wave 2 or a wave 4. And now you have a little bit extra context to begin your analysis. I hope I'm making sense. It's a very complicated question here, or answer, because your question was a double question, and it required quite a bit of an answer here. So I hope that it answered. If it didn't, please let me know, so I can try to simplify somehow. Okay, so Steve asked, does that depend on the market? So we can see different waveforms more often in certain markets and not others. Well, certainly, certain markets have personality, characteristics, and they tend to form more particular patterns. I'm not talking specifically, I suppose your question is related to the diagonals that we were discussing before. But in this case, we are discussing pretty much whatever pattern. Are there situations or markets specifically that prefer a pattern over another? And I would say, yes, I would think so. For instance, whenever I'm labeling a Japanese pair, I always look for triangle, because it looks to me that any pair that is Japanese related forms triangles. Now that could be an impression, not necessarily a universal truth, I must say. it must be some subjectivity there that I am, you know, generalizing. But I would say yes, markets do have personality, and if you are very familiar with a particular market or not, you will encounter more or less patterns, specific patterns in that market. Now, having said that, I should say, if I were to be a good mentor to you, I would say, you know, markets, charts are the same. You should ignore what pattern or what market you're labeling, and just focus on price, on what the patterns are being formed there. And regardless if it is euro, if it is yen, if it is gold, or if it is a futures, or it doesn't really matter. Just look at a chart. So I hope that answers that question. That was very clear. Thank you very much. I'm glad to hear that, because the question required some really deep digging. I would like to know how to project a wave 3. Yes, well, we all want to know how to project wave 3s. The reality is that many people talk about wave 3s being or expected to travel 1.618 the distance traveled by wave 1. Let's say that we have here a wave 1, then we have here a wave 2, and so wave 3 is moving along fine, and you want to know, maybe you bought here, and you want to know, where do I exit? So what you do is you use your Fibonacci extension tool, which I posted a video a couple of days ago, and I had this funny comment of somebody telling me, you don't know how to use the Fibonacci tool, you're using it wrong. It really made me laugh. But basically you use the Fibonacci extension tool, you measure wave 1, and then you project that from wave 2. And then what you expect, theoretically, is that wave 3 would typically travel to 1.618, the distance traveled by wave 1. I think if I had a penny or a dollar, let's say, for every time that this didn't happen, I probably would be a super millionaire, because I hardly see wave 3s going to 1.618, even though it is the standard, let's say, perception that wave 3 travel 1.618, the distance traveled by wave 1. If you look at books, they will tell you 1.618 is the expected distance or target for wave 3. In my experience, that is not the case. Could I say that wave 3 travel instead to the 1.382 as I drew it? I couldn't tell you that either. Is it possible they travel 2%? And I could say, no, not necessarily. Sometimes they do, sometimes they don't. How about 2.368? Couldn't tell you either. What about 2.618? Well, I couldn't tell you. Because the reality is that wave 3s are all over the place. They could end at 1.382, they could end at 1.618, they could end at 2.0, sometimes 2.236. You know, they could end anywhere, and sometimes even in between, to be honest. So how do we project a wave 3? Well, the trick here is to talk about time frames. So my apologies if my answers are too complex, but I'm giving you the really correct answer here. Let's say that wave 3 is on a, let's say, a 4-hour chart, right? And you want to know where it's going to end. Well, my suggestion is that you don't project it on a 4-hour chart, but instead you move to, let's say, a 30-minute chart or an hourly chart, where you can easily spot the 5 internal legs of that wave 3. Why? Well, for one simple reason. Wave 5s are very reliably projected, whereas wave 3 are not. So if we can spot 4 waves of wave 3 in a smaller time frame, then we will be able to spot the end of wave 3 in that larger time frame. Okay, so all we have to do is to project wave 5. So the question here is not so much how do we project wave 3s, but how do we project wave 5s? And the answer here is really reliable. I could tell you that wave 5s can typically take the a Fibonacci ratio from either wave 1 or the distance from wave 1 through wave 3. So let's discuss that. So in this case, let's say we measure wave 1 again, and instead of projecting it from wave 2, we projected it from wave 4. And at this point, we could expect, if wave 3 is really strong and extended, we could look at the 100% of wave 1. Okay, so basically wave 5 and wave 1 would tend to equality, and that's fine, and that's very, very reliable. It happens often enough as for you to be considering that could be a very potential end to that wave 5, which in this time frame would imply the end of wave 5, but in the larger time frame it would imply the end of wave 3. So what you are actually doing is projecting the end of wave 3 by projecting the wave 5 in the smaller time frame. So it could be that it's not the 100%, but it could be 1.236, 1.382, even 1.618. It typically goes with a Fibonacci ratio of wave 1. And that is something that is really, really reliable. Another way to project a wave 5 is by using the distance traveled by wave 1 through 3, meaning that you measure from the origin of wave 1 and go all the way to wave 3 instead of wave 1. You go all the way to the end of wave 3 and then project that from the end of wave 4. And at that point, you will find that wave 5 will typically travel a Fibonacci ratio distance of the entire move, typically 0.618. That is very reliable, and it would be convenient for you to actually make those projections and the different projections there, because anywhere there that a cluster forms will be a very good candidate for you to spot the end of wave 3 in the larger time frame. And another very, very reliable way to project wave 5, and already you have several ones here, but another very reliable one is by measuring wave 4. So you start from the bottom of wave 4, go all the way to the top of wave 3, go back to the bottom of wave 4, and then consider that wave 5 will typically travel at 200% of this distance, of the distance of wave 4. This is extremely reliable. It's one of the most reliable target process that we use and that we have seen and that we have learned. So basically, in short, how do you project wave 3s? Well, you don't. You project the wave 5 of 3. And in order to do that, you typically move to a smaller time frame where you can indeed spot the 5 waves subdivisions of that wave 3. Hope that answers your question. Let's see if it does. Let's see if we have any more questions here. I like how you simplified Elliott. Thank you very much. I try my best to make it as simple and as approachable as possible, since I believe is the greatest foundation of technical analysis. It's probably one of the best and most reliable tools we have. It's the most objective for sure, because we have rules that we don't have in any other analytical system. We have guidelines. We have guidelines in other analytical systems, but not as precise as the ones in Elliott wave, where one tick, one pip could imply that you are wrong in your analysis. And that precision of one tick or pip can make a huge difference. So you said, how long did it take you to be confident with your knowledge and take successful trades? Oh, now you're embarrassing me. Well, to be honest, it took me a long time. I wasn't very fast. I wasn't very talented for this. I thought I would be, because I had a big opinion of myself. I was much, much younger, and I thought I would be great at it, and I discovered that I wasn't. And it was very difficult to accept that. So I thought that I could learn this on my own. I thought that if I took a book like I did with any other subject, I would learn it. And with Elliott wave, it was a bit different, because sure, you can take a book and learn it, but you will learn the theory of it. You will learn the rules, the guidelines, but you will not learn the applications. You will not know if what you're doing is correct or not. So I don't think it is possible to learn Elliott wave without a proper coach. So it took me 7 years to understand that truth and to accept it. And it was only after 7 years of learning, of frustration and losses, that I finally engaged the help of someone who would coach me in detail and show me where I was wrong and where I was right, what I was doing properly. And it was then when I started finally being able to apply the Elliott wave principle, because believe me, in 7 years you can learn a lot. In particular, you are very studious and you continue reading and seeing how other people do it, and you can get very excited, but when you try to do it, it doesn't work. So that happened to me for 7 years, and yes, now I could be very embarrassed to say that, because now I'm presenting this as an authority, and the reality is that it took me forever to learn and to take successful trades with it. Yes, it took me that long. Now, is it necessary? Well, no, for several reasons. One, if you accept from the beginning that you are not a genius and you ask for help from the beginning, you probably are going to save a lot of years. Secondly, if you actually take the help of somebody who knows it well, I have had a lot of difficulty to find someone that actually knows it properly, and then you have to find somebody who knows it well, and then somebody who teaches properly and who actually enjoys teaching it, because some people could be very good at anything and very bad at teaching it, You can see some great pianists or concert artists that were phenomenal performers, but at the time of teaching, they really suck. So it is not necessary to take that long. So if your question is not personal to me, if your question is how long does it take to understand and properly apply Elliott wave under the ideal guidance and be successful with it, I could tell you, well, if you are under the ideal guidance, you probably will take several months, not more than 4, maybe 5 months. And to be successful at it, yes, it will take you more or less something like that. If you are studious, have the proper materials, and are under a guidance of someone who is willing to really guide you and take you by the hand and show you and not hesitate to tell you you are wrong. Okay, so should I stick to my first count or constantly update it as the market moves? Well, this is an interesting question, because this is almost tantamount to ask, if I am doing something wrong, should I stick to it or should I change courses? No? So if you are labeling, or you have labeled something, and you establish, as I said before, the wave principle gives us precise guidelines and rules, and you establish those key levels, we tend to call them critical levels of support or resistance, and those levels are violated, then it would be not very intelligent of you to stick with it. Let me put it this way. Let's say that we have a move in the market that looks like this, and we label it as 1, 2, and 3. So now we're expecting a wave 4, and as luck have it, prices start coming down. Let's start coming down. But now prices start coming down a lot, and now have overlapped the end of wave 1. Should you stick to your wave 4? Well, no, because it is already invalidated. So it doesn't make sense to do that. So what should you do here? Well, immediately consider the fact that if this was invalidated, and you were considering this as a wave, as a 3 waves up, well, maybe it's an ABC. So now immediately you have to change it to an A, then a B here, and a C, right? You have to adjust the count. And is adjusting the count something bad? Well, not if you want to trade successfully, unless you want to just prove your ego right, then, well, you need to decide whether you want to be right or you want to make money. And so I think most people would say that they prefer to make money than to be right. And the same thing applies. Let's say that you are expecting a correction, and then you label this as A, B, and C. So you want to go short there because, well, you know that corrections tend to be typically retraced. So you sell there, and as luck will have it, prices start coming down, but they stall by the 38% and they start going up. And then you see that and you say, no, I'm going to stick with that count. And before you notice it, there is another high that took this high and now invalidated your count. So are you going to continue thinking this is an ABC? Well, no. Now you have to adjust and say, no, it was a 5-way move. I was wrong. And there is nothing wrong with being wrong, you know. The reality is that we are wrong almost every day. You know, the entire time that we're, I think basically, if you are forecasting, you have to accept that you're going to be wrong. If you are trading, you have to accept that you're going to lose. Now the question is, well, how often are you going to be wrong, and how much are you going to be losing? How much are you going to allow for that? And that's where good money management comes, good risk management, and so forth and so on. But yes, your account must be adjusted. Now, if you are asking me for something completely different, like you have, let's say you have a triangle here, and you are thinking this could be a triangle, you know, you have something like that, and you say A, B, C, D, this could be a triangle, and well, you're expecting an E here to go long, and the E doesn't go to the level where you expect it. Well, at that point you probably don't have to adjust the count, right? You just have to then trade what you see in front of you. So if prices start moving up and break wave D, then instead of entering the market right here at your suspected wave E, you enter it when it breaks a wave D. And then you are still in a good trade, but the reason was because you were able to adjust. The capability of adjusting here is a must. It's something that you have to always have, be nimble to adjust, actually. Hope that makes sense. Okay, you have the most sweetest and the most calm way of teaching. That is so kind of you to say. Literally, my mood calms down when I watch your lessons. Love from Pakistan. Well, love back from Germany. I'm glad to know that you get calmer when you hear me. In the past, people complain that when they hear my videos, sometimes they fell asleep. And, well, that wasn't good. But if it is calming you, that's fantastic. That's great. Because at the end of the day, you know, when you think about what do people want, you know, we always think we want to be happy. But at the end of the day, when you become older and hopefully wiser, then you start realizing that what we want is not necessarily to be happy. What we want is peace. And so having calm is a wonderful way. And to be honest, one of my most, I would say, my strongest desire at the time of teaching my students to trade is how to accomplish a trading experience that is not just fun, but that is full of calmness, is full of certainty and confidence. I don't really like the idea of trading when you have to be so stressed out because you put a position. I think I prefer to have an experience of trading and to have my students have an experience of trading where they are calm and certain and confident of what they did because they did it, not because they had a gut feeling or anything like that. They did it because they have a thorough analysis that allows them to come up with a conclusion that they trust and that typically would work. Okay, so there is a question of topic that do you trade BTC? If not, why not? Yes, I do, and yes, I don't really devote entirely to that as many people do. You know, some people trade BTC just because they feel that by trading BTC they will become billionaires and whatnot, and all the offers of BTC and all the conspiracy theories and all that. I don't really get involved with any of that. I trade it as I trade any other market. Now, one of the reasons why I trade it is because a very large number of my students want to see my analysis on BTC, and so if I go through the trouble of analyzing it, then of course, if I see an opportunity in BTC, I would take it as I would take it in any stock or any forex pair or any market indeed. Can I use Elliott wave on any market, like crypto or specific low volume stock? At least in my experience, I noticed that in some markets, it's much more difficult to spot the patterns. Well, you are correct. Some markets don't display very clearly the Elliott wave patterns. That doesn't mean necessarily that the patterns are not there. What it means is that we probably are using the wrong time frame to see the patterns in that particular time frame. So in that case, we need to move from time frame, often going to a higher one where we could see more with an altitude, with distance, and then we could see that something that looked absolutely crazy in, let's say, an hourly chart, if you go to a daily chart, it looks like a simple correction and you don't have to worry so much about it. Now, the first part of your question is, can I use Elliott wave on any market? And the quick answer is yes. And yes, you can apply it to crypto or any market or any stock. But you mentioned something key there, which was low volume. When there is low volume, it could be that that particular stock is not really traded by many people, and you have to consider something. What Elliott wave does is to pattern the social behavior. So if we don't really have a lot of people trading a particular market, then the collective behavior of that will not really be clearly displayed as Elliott wave patterns. So if you find that there are too low volume stock, perhaps it's better not to trade that one, because you won't be able to trade it with the confidence that it will give you that those patterns were formed. And so in that case, yes, you want to trade markets that many people are trading, because that would help you spot better Elliott wave patterns, because that at the end is what the Elliott wave principle is. It's mapping out patterns of social behavior. I hope that makes sense. I'm sorry, Professor, just one last question. No problem. You can ask as many questions as you please. And I appreciate your time. Do market fundamentals, news, economic reports, etc., ever invalidate an Elliott wave count? Only if the Elliott wave count is incorrect. So those news, those economic reports, etc., they only move or affect the short-term time frames. So if you are trading with longer time frames, you probably don't even have to look at those things. No? Personally, I never do, because I'm a technical analyst, and technical analysis is precisely the methodology that allows you to forecast future market move based on market history. It doesn't allow you to forecast future markets move based on what the news are going to say. So that's not technical analysis. Therefore, news, economical reports, etc., have nothing to do with technical analysis. Can they affect a market? Well, sure, they will affect the market in the very short term, and particularly in very low time frames. But will they invalidate the wave count? Not if the wave count is correct. So let's take an example. Let's say that that's a simple thing. Let's say that we have a wave 1, or what we think is a wave 1, and we have a 3 wave down for a wave 2, right? And we want to take a long here. So the question is, there are some news here, whatever news are there, and let's say that this is a very short time frame. Let's say this is a 30-minute time frame, okay? And there are some news. And, well, the news make this, right? So while the news are happening, you see the market going up and then go down and then continue going up like crazy. Well, did it invalidate the count? Well, no, because you had a wave 1 here. You were thinking that this was wave 2, but, well, you were wrong with that part. You were not in wave 2 here, but wave 2 is right here. And these fireworks were just part of the wave 2, and send the market in the direction of the analysis if the analysis was correct. So the news will not affect the forecast if the forecast is the correct one. Now, if the forecast is the wrong one, sure, it will affect the count. Now, that is in relation to the count. In relation to what's happening in the short time frame, sure, the news, when the news happen, you will see fireworks, prices going up and down like crazy, and yeah, that will affect you if you are in those time frames. But if you're not, personally, I never see them. I never trade of small time frames. Okay, so what is the best stop loss strategy for Elliott wave analysis? And thank you very much, says Steve. Thank you, Steve, and have a good day. What's the best stop strategy for Elliott wave analysis? This is, again, a very interesting question because the formulation of it is strange. Wave analysis doesn't require stops. Okay, when you do wave analysis, you do it to project, forecast a market move, or the most likely meaningful market move to occur. So if we change that question and put it into the right frame, we would say, what is the best stop strategy for trading applications of the Elliott wave principle? And in that case, then we have to go back to the normal, usual pattern, okay? The most simple 8-wave pattern that describes, in a nutshell, the entirety of the wave principle. So let's say that we have 1, 2, 3, 4, 5, and A, B, C. As you probably are very familiar since you have been taking my intensives and lessons, then you know that this is a 1, 2, 3, 4, 5, and an A, B, C here, right? So the question is, well, what do we trade? Using the wave principle, what do we trade? Well, we don't trade everything, as I was telling you before. We don't want to trade the beginning of wave 1 or the beginning of wave A because, well, we don't have a very precise place where to place a stop, and that's probably why you're asking the question. So I suggested that it was better to wait for an 8-wave cycle, meaning that we wait for this 1 and ABC here for wave 2, and then we have an 8-wave cycle there. So if that's the case, basically we want to trade wave 3s. And after wave 3, what do we have? Well, we have 5 waves up and 3 waves down. So again, we have an 8-wave cycle here. So we can trade wave 5. So again, we have 2 waves here that we can trade in the let's say in the face of an uptrend. We have wave 3 and wave 5. And one of the reasons is because we have the 8-wave cycle, this big thing, right, happening. We have it happening here, we have it happening here. Now, we don't really have it happening here, but we do have it happening here, because if this is an ABC, we have 5 waves here and 3 waves up here. Therefore, we could trade wave C's of a zigzag. Like in this case, I drew this as a zigzag, right? So we could trade basically wave 3, wave 5, and wave C's. So what is the stop? Well, we use the wave principle to place a stop. I know everybody will tell you, you trade money, so you basically have to put a stop based on money. Well, I don't think that's very wise, because I think it's better to trade patterns. And so when you trade wave 3, you can use the first rule of the wave principle that tells you that wave 2 can never travel more than 100% the distance traveled by wave 1. Therefore, if you buy wave 3 down here, where you thought wave 2 was going to end, then your stop is precisely the law of wave 1. Now, that's for trading wave 3. If you are trading wave 5, you're going to buy wave 5 at the 38% retracement of wave 3. So let's say that you buy wave 5 here. Where is your stop? Well, where your next rule is. What is the next rule? The next rule says that wave 4 can never end in the price territory of wave 1. So this level here would be your stop for trading this. And the same thing applies for the wave C of a zigzag. This is the next wave you're going to trade, right? So we have 3 waves of the entire 8-wave cycle that we can trade. So if you're going to trade wave C, you want to wait for this 8-wave cycle, right? Where you want to enter right here, and your stop will be precisely here, because wave in a zigzag, wave B can never travel more than the entire distance traveled by wave A. Otherwise, it's not a zigzag. Therefore, you have specific levels where to use your stops in ways that you can rely on, in ways that you can count on the fact that, well, by placing your stop there, you're not going to see or suffer, undergo that torture that happens when prices go against us, pick up our stop, and then go all the way in the direction that we were originally thinking prices were going to go. That happens to everybody. That happens all the time. But it doesn't happen if you are an Elliottian, because if you use the Elliott wave principle to place your stop, if prices, for instance, if prices here went below the low of wave 1, well, guess what? That is not a wave 1 and a wave 2. It could be something else, but it's not a wave 1 and a wave 2. So you are not trading the wave 3 that you were thinking you were trading. Therefore, it is better to be out of that market because, well, let's admit it. You were wrong. Makes sense? I hope it does. So that would be the way that we use stops in the wave principle. And I don't know if that's what you meant when you said the best strategy for Elliott wave analysis. As I said, Elliott wave analysis would not require a strategy, because Elliott wave analysis basically is done to project, to forecast. As always, so much value. Thank you so much. Thank you for your answers and for the great channel. I hope you are planning to do more video or live streams on the wave principle. Indeed, I will focus a lot on the wave principle because I have seen how many people really want to learn the wave principle and the need for proper learning of the wave principle. I think I'm going to stop now, and so if you want to know how we can help you with our program, it's called Trading Mastery. You can arrange a call with me or my team anytime. You will find the link below all our videos, and you can arrange a call, and if we will discuss your system, your way, the way that you trade, and if we can help you. So I look forward to your call and maybe meeting you on one of those sessions. Thank you so much, and I'll see you very soon. Bye-bye for now.